Hi, Steve. What you're about to see here is something that's been in development we've been using for about 20 years, but it's based upon 50 years of knowledge in the retirement plan business as a TPA, third-party administration firm. And we call it our STAR strategy. The word STAR stands for Save Taxes and Retire. Or if you're more in the dirt like I am sometimes, we call it Screw Taxes and Retire. It's the RMD tax remedy. Now, if you look below in the lower right-hand corner, you'll see that when I looked up remedy, I about fell off my chair. An act of correcting error or evil or fault. So what we do here in the STAR strategy is we sequentially reposition. So it's a bit like playing chess and moving some pieces around the chessboard. But we reposition pre-tax retirement assets into an index universal life policy, which is specially designed just for this type of transaction. And then also we convert traditional after-tax investments into Roth, which is normally something you can't do. But there's a point that I'll make here shortly about those after-tax assets. And here's my disclosure that you need to check with a professional regarding these things that I'm showing you. But what makes you as an advisor different from all your other advisors? And this article in 2022 from the 401k Specialist magazine pointed out that many investment and retirement consulting firms are questioning their black and white strategies and their traditional business model, because they've learned that they have to adapt to, particularly around tax, to move from a red ocean to a blue ocean. And that adaptability is probably key to survival, creating value for your clients that others can't, won't, or don't. Now, why STAR? The way I look at it is, if you're repositioning your client's taxable assets to tax-free, you have definitely repositioned your value proposition to your client. Too many people just follow the true and tried, what they think are the old rules. And of course, the question always that you want to ask somebody is, if you knew something that, if you were certain that something was correct and it wasn't, how soon would you like to know? And rather than following the Wall Street, as this unknown author says, be careful when you're following the masses of what everybody else does, because sometimes the M is silent. So I'm going to talk about the STAR strategy, the gold version of it, which is the standard, where we take 2 buckets of money to a third bucket to create this value proposition. So bucket number 1 is the taxable bucket. That is your after-tax investments that you have in CDs, bonds, mutual funds, real estate, and all sorts of things. That now it's after-tax money, I agree with that, but one thing that people need to realize and get their head wrapped around is that everything that after-tax money earns, all the K1 distributions, dividend distributions, interest credits, all of that shows up on your 1040 and you pay tax on it for the rest of your life. And then you have the tax-deferred bucket, number 2, which is all the pre-tax money in 401ks, IRAs, 403bs, 457s, simple SEPs, all profit-sharing plans, defined benefit plans, and every bit of that, everything you put in, everything that's earned comes out as taxed as ordinary income. So it's taxable for life. And then bucket number 3, which we know that over 95% of Americans don't use because they have their monies in bucket 1 and 2, is the tax-free bucket, which is Roth, muni funds, life insurance, and perhaps Social Security if they've done the right type of planning. And a lot of Americans don't realize that 50% to 85% of the Social Security is taxable. That's unnecessary. So let's talk about Dr. M here, who implemented the STAR strategy late last year. And she had, in bucket number 1, about $400,000 invested primarily in mutual funds. She also had, at that point in her career, and she was in her early 50s, accumulated another $500,000 in the tax-deferred bucket, primarily in her 401k plan. And we discussed with her about the opportunity to move that money over to tax-free. When I say tax-free, I'm talking about income tax-free and estate tax-free for the rest of her life. Now, the problem with her and many other people is that they have no idea what they're going to pay on their retirement plan assets during their retirement years. In fact, as a general rule, for every $1 million, and you can cut that in half or divide it by 2 or multiply it by 2, for every $1 million you have in a retirement plan, if you just take RMDs, you'll pay over $1.6 million in taxes on that $1 million, assuming a 5% earnings rate, and just taking RMDs to age 95. In her case, on those two assets, the $400,000 she had of personal money and the $500,000 she had of pre-tax money, she was determined she was going to pay in a reasonable tax bracket with a reasonable 5% interest assumption, over $800,000 in taxes on those two buckets when she retired. Whereas by converting those two buckets of money to tax-free, she'll pay a one-time tax in the third year of about a little under $200,000. So she's cut the taxes on those two buckets for the rest of her life by about 75%. And as my favorite judge says, that you don't even have a patriotic duty to increase one taxes and pay the Treasury something you don't need to pay them. And his more generous quote, or more famous quote, in America there are two tax systems, one for the informed and one for the uninformed, and both are legal. I'm about to talk to you about the uninformed and the informed advisors. So here's the uninformed advisor and his or her advice. If you need the money for after retirement or during retirement, you can spend it as needed. Everything you take out is taxable. You can not take the money, but you still got requirement of distributions, and that's taxable. Or you can consider a conversion to Roth, and that's taxable. But what about many clients have income from other sources and they don't need the retirement plan money? Well, if you don't need it, that's tough tacos, because you still got RMDs. You're going to be required. The other government wants its share of the account, and this is the only asset that you don't really know how much you own. In the old days, we used to have a stretch out, but the Secure Act of 2020 simply changed the rules that we can no longer pass these assets, retirement plan assets, from generation to generation and draw down over those generations' lifetimes, called stretch out. Now, any money inherited by family members other than your spouse, that money must be distributed and tax paid over a 10-year period minimum. And here's the informed advice. By repositioning qualified plan assets into index UL life insurance and converting personal assets to Roth, which is normally not allowed to do unless you do this sequential planning that I'm talking about. If your pre-tax money is needed, then spend it as you need it. All income is tax-free for life. If your pre-tax money is not needed, well, you can let it grow for a lifetime and pass it on to your heirs tax-free. You can maximize wealth to charity and or family. And you can provide additional living benefits that are attached to the program in the forms of long-term care benefits or living benefit riders. But over the years, we've had to develop 3 versions of STAR, because as we presented more and more of these STAR cases to clients, we learned that we needed to account for the differences in financial capabilities. So STAR Gold is the standard, where these candidates have 2 buckets of money. They have money in the after-tax funds in buckets, in bucket number 1, and they have significant tax-deferred money in bucket number 2. And we converted both those 2 buckets to tax-free. However, we ran into some candidates who developed a STAR Silver program where they had money in qualified plans, but they hadn't been very successful saving personal money, making personal investments, so they had little liquidity that was outside the retirement plan. And so we only convert their qualified plan money to assets. And then we had to develop the STAR Platinum strategy, because we ran into clients that had significant income and net worth that qualified for not only implementing the STAR Gold strategy, where we convert 2 buckets to tax-free, but we could add more money into the program by borrowing from a bank to create an arbitrage play where the cost of money was less than the opportunity on money. And so these are the 3 types of STAR programs and who it primarily benefits. Generally, we're looking to help people convert over $500,000. Now, you can do it at almost any level, but we try to stay with $500,000. And so under STAR Gold, they have 500,000 or more in pre-tax funds. They have a similar amount of personal money that we can use to structure also tax-free, and they control or influence a qualified plan. So we can't do this for somebody General Motors. So we're talking about small and medium-sized business owners who have the ability to control their retirement plan. Then we have the Star Silver program, where we're turning one bucket to tax-free. They generally are age 50 and over and have 500,000 in pre-tax funds, and they have no or limited personal post-tax liquid assets to also bring into the strategy. But they also need to control or influence a qualified plan, and the qualified plan must have certain distribution language which we put into the plan documents. And then for the big boy, the Star Platinum, we're converting two taxable buckets to tax-free using the Star Gold, and we're going to enhance that program by we call our Prestige strategy, which is a premium finance strategy. Again, we're looking for clients with $500,000 or more in pre-tax funds. They have an enhanced amount of personal post-tax liquid investments. They have the net worth and income that qualify for premium finance, which is a whole different strategy, and they control or influence a qualified plan. But these are the three steps we go through to implement the gold strategy. Step number one, the money in the tax deferred bucket. We use that to buy a very specially designed life insurance policy, which is generally not available to the public, and it's designed in a way and differently than most insurance agents design product where they try to maximize commissions. We're actually designing it to absolutely minimize the cost, which is minimizing the compensation also. So that's contrarian. So once we have funded insurance policy, now we could fund it over 2 years, 3 years, or 4 years, but let's assume that we fund it over a 3-year period. So if we have $900,000 in the retirement plan, we would put $300,000 a year into the specially designed index UL policy. So at the end of 3 years, that policy is fully funded and has a minimum death benefit that's controlled the cost. So, but once we've completed step one in terms of funding the policy, we need to get that policy out. So we move on to step two, where we use personal assets to buy that policy out, and I'll talk about why we're allowed to do this. So after step one and two are completed, the policy is moved out of the tax deferred bucket over to the tax-free bucket. Now that life insurance, the death benefit, all the earnings and all the income that come off that policy, all the living benefits are tax exempt for life. However, under step two, we put your personal assets back in the tax jail, back in the tax deferred bucket. So then we go on to step three, is that personal money that went from bucket number one into bucket number two, we now convert to Roth, and that is now over in bucket number three. And so now we have two assets in the tax-free bucket. We have the life insurance policy money, which came from the pre-tax money, and now we had also the Roth, which came from your personal money. So there is a tax due on that Roth conversion. That's a one-time tax our client will pay for the rest of their lives, which generally cuts the taxes by 75%. Now, we always compare STAR to status quo. Now, the word status quo simply means don't do the strategy. Don't, just keep doing what you're doing, and don't implement the STAR. Status quo is, so what we do is we run the STAR. Once we know the individual's assets that we're dealing with, we run the STAR goal to see what kind of income that'll produce to age 100. And once we know that number, then we apply that to the status quo and see how long that money would last. But as you know, what President Reagan said at one time, status quo, is Latin for the mess we're in. That is correct. With everything that's happening in our country in terms of debt and liabilities and the political chaos we have and all of the black swan events seeming to happen around the world, I'd like our clients not to have to worry about those things anymore. So let me give you an example. Let me first focus on this individual's goal. Here was a female doctor, very successful, age 53, and her goal here was from these two assets to have $360,000 a year of net after tax or tax-free income. Now she had two assets. She had $4 million in her qualified plan, and we put that into an insurance policy over 3 years at the rate of $1.3 million a year for 3 years. So at the end of 3 years, we put all $4 million into an insurance policy. That especially does on insurance policy. Would insure her for a little over $15 million of death benefit. But at the end of 3 years, we then use this money to buy that money out of the retirement plan and then convert that to Roth. So let me show you what that looks like. So So the three important things in someone's life are, if they're going to take this money out and spend it, what is left over of their net worth, and when they pass away, what's going to heirs. So these are the three most important things in people's lives. If I burn off this money and income, what's left of my net worth and what's left going to my family. So first we run the STAR, and out of those two assets that I showed you, we could generate over $360,000 a year all the way to age 100, although I could only get 40 lines on this page. So at age 92, she would have had, under our strategy, a little over $12 million of tax-free income. And if she passed away at age 92, she still got over $3 million of net worth liquidity. And when she dies, $4.7 million going to her family. Whereas if STAR produces over $360,000, if we use that same number for the status quo, assuming she didn't do our strategy, she could have the same net after-tax income. Now remember the words I used: $378,000 in our strategy is tax-free. In this strategy, $378,000 is net after-tax. And by her middle 80s, she has completely run out of money. And if she were to pass away any time after that, there's nothing left over for her family because no more income can be paid. So by age 92, we've created $12 million of income versus $9 million of income. And that's the typical outcome we have by converting pre-retirement and personal assets to tax-free. Now here's another example of a younger individual, age 49, and his goal was to retire with $100,000 a year. And he had $1 million in his retirement plan, which is a more typical example. And he had a little over $700,000 of personal money he could use to buy the policy. Now, we can see that putting $1 million into a policy over 3 years at $333,000 a year for 3 years, we only require 4.4. Now, 4.4 is the minimum death benefit that we're required by law, because Code Section 7702 controls the amount of death benefit we have to fund a policy over a short period of time. And it's not our choice; it's just what the government regulations require if you want all the tax benefits of life insurance. So in his case, his goal was $100,000 tax-free, starting at age, and he wanted to retire early, so age 59. The STAR strategy would provide him $108,000 all the way to age 100. Now, I only have 40 lines on this page. So if he only lived to age 88, he would have had $3.5 million of income, or he'd only have $2.3 million, 2.4, if he did continue to do what he's doing. And then there's over $1 million left over in liquidity, and over $1.5 million, or close to $1.5 million of money left over for family. And just to show you, I carry all the numbers out to age 100. So if this guy were to live into his 90s, and if he was one of the fortunate people to make it to age 100, he would have $4.5 million of tax-free income, and versus $2.4 million, and he still got $400,000 of cash left, and a benefit going to the family of over $400,000. So that's the power of the STAR strategy of creating all sorts of tax-free income. Now here's a summary of all the total benefits and tax costs, age 100. So for this individual, if he does this, and I'm only assuming 4.8% interest earnings, he would have $4.5 million of income. He'd still, at age 100, he's still got $400 left over for family, and he'd only paid $371,000 of tax. Whereas if he did the status quo, he would have had just a $2.5 million almost. So we've had $2 million more of income. He's got nothing left at age 100, and he's paid $1.2 million in tax. But these are the regulations most advisors don't know, that what allows us to build strategy on a legal foundation. And that is the Department of Labor has a prohibited transaction exemption, PTE, which simply says that any American in the United States can buy life insurance on a retirement plan and can get that life insurance out by sale or distribution and not be a prohibited transaction, because there's all sorts of prohibited transactions generally referred to self-dealing, where you're self-dealing with assets in a retirement plan. But this is an exemption where you can get the life insurance out personally by either buying it or distributing it. In addition, whenever you're dealing with retirement plan assets, the IRS is concerned that you're dealing with the real values and not making up fake values to reduce the tax. So they issued IRS Revenue Procedure 2005-25, which is the safe harbor for pricing the sale or distribution of a life insurance policy coming out of a qualified plan. So these are the two goalposts for doing this right, and we have to follow these to the letter of the law. We structure it properly under the Department of Labor regulations, and we distribute it on the price or sell it on a price that the IRS will approve of. However, you may ask for our ERISA tax memo that we cover all the details from a tax standpoint, that you can be sure that we're doing what is proper here. This is our contact information, and so you'd like to get a hold of us or have more information, just contact us, and we'll go ahead and get all that information to you.